All right, in this lesson, we're going to talk about just an overview of the rules that we follow when we are dealing with financial accounting. Now, these rules are not necessarily the same as managerial accounting. You'll learn that in a managerial accounting course or a Principles 2 course. But in this course, when we talk about financial accounting, we have to follow certain rules when it comes to preparing financial statements for external users. So we're going to kind of give you an overview of what those rules look like or who governs them and how are they put together. And we're going to help you understand some of the guidelines we have when it comes to these rules and implementation from a financial statement process. So the first thing let's talk about is kind of these rules. Who comes up with them? Well, accounting is governed by a set of rules that are developed by the Financial Accounting Standards Board. So we call it FASB, F-A-S-B, the acronym for those 4 words, Financial Accounting Standards Boards. There is a board that comes up with basically the rules that we as accountants follow. Those set of rules are called Generally Accepted Accounting Principles, or US GAAP. You'll often hear a lot of accountants call it GAAP or US GAAP. That's Generally Accepted Accounting Principles. And the reason why it's called generally is that we collectively as accountants agree that this is the right way that we should treat a transaction of this nature in the books of the financial statements. Does that mean that every accountant agrees? Not necessarily, but generally speaking, we all kind of agree that this is the way accounting should be. So that's why it's called GAAP, or Generally Accepted Accounting Principles. Now, there are different GAAPs for different places in the world. We talk about US GAAP, United States GAAP, but there are other types of GAAP. One of the biggest gaps is not US GAAP, but it is internationally, and that it's developed by the International Accounting Standards Board, or the IASB. They come up with kind of a standard of GAAP, you could say, for those countries that want to adopt it. So in the United States, you have to use US GAAP. That's the adopted Generally Accepted Accounting Principles in the United States. But throughout the world, they may decide that they want to follow IASB. Why? Because they have a different look at how accounting should be from a financial statement standpoint. So this is one of the biggest ones, and the reason why this is one of the biggest ones is because a lot of countries decided to adopt this standard versus making their own standard or maybe using US GAAP. So again, there's a trade-off. So a small country may decide that they don't want to come up with all of their standards, so they're going to adopt some other standards, and in that case, that's this one. The reason why this one comes into play is because we are a globalized business world. And so the idea is that because we are such a globalized business world, we should be able to compare not only financial statements within the country that we do business in, but we should be able to do it internationally. So for instance, America Honda is based in Japan. We should be able to take their financial statements and compare them directly with, let's say, Ford in the United States. Well, if we do that now, the Japanese company Honda uses a different set of standards versus the United States Ford company, and so you really can't compare them because the valuations might be a little bit different between one set and the other. So in this case here, that's why the IASB decided, you know what, let's create one and have other countries adopt this one as a way to make things more comparable throughout the world. Now, what is the standard? I haven't even said what the standard is. The standard is called International Financial Reporting Standards, or the IFRS. So IFRS is kind of what a lot of the world uses. So like Canada uses a form of IFRS. Europe uses IFRS. So a lot of countries use IFRS as their standard for financial reporting. In the United States, we use US GAAP. Now, why do we have these rules in the first place? Well, there are some reasons. One is that GAAP ensures that companies are producing financial statements that are useful to external users, right? So what is our goal? Our goal is to provide information to external users so that they can make appropriate decisions on whether or not they're going to invest, hold, or sell their investment. So buy, hold, or sell, okay? And so we want a set of rules that helps people or companies comply with certain things when it comes to their financial statements so that the public can actually use that to make decisions. And so if everybody had their own standards, businesses could do whatever they want and report whatever they want, however they want, and that would be confusing for the shareholders who needs that information to make a decision. Now, GAAP helps us to ensure financial statements at the end of the day are relevant, as well as faithfully representation of what the company has done. So what do we mean by relevant? Relevant means that the information that's being provided is useful to the decision maker to actually make a decision, right? So we're giving them information that they actually can use to make a decision. We're not going to give them random information that doesn't even matter. So for instance, someone who's investing in a company, they might not care how many miles it takes to get from their headquarters to their warehouse, right? Because who cares, right? At the end of the day, that's not going to make or break an investment. So that information shouldn't be on the financial statements because who cares what the headquarters and the warehouse distance is. But we want to know maybe what cost of goods sold is so that we can see a trend in cost of goods sold, which actually affects profitability at the end of the day. So we want to make sure that information is relevant. And so GAAP ensures that the things that we put in the financial statements or how we put them in the financial statements are relevant to the decision maker who's going to use that information and rely on it at the end of the day. Now, faithful representation means that a company actually faithfully represents their numbers as true and honest. So GAAP does there's a lot of rules in GAAP that at the end of the day, FASB wants to ensure that actually represents what the company does and doesn't necessarily sugarcoat it or as it's just an optics number, but that we're calculating it the same way so that it actually makes sense at the end of the day. So we want to represent the numbers as they are. So if we said we had profits of 25,000, we actually had profits of 25,000. We didn't gussy up the numbers to make it look one thing when it really is something else. So that's our goal here when we talk about GAAP and how they interact with financial statements. Now, we can enhance the information that we're providing to shareholders through these 4 ways. So these are enhancements to making sure that the data that we're providing to shareholders actually makes more sense than if we didn't do it. The first one is timeliness. So we want to make sure that the information is provided to the shareholders in a timely manner. So for instance, if we are 20x1, for instance, we probably should get those financial statements closed into the owners, shareholders' hands within a few months, right? It's going to take a bit. I mean, we're talking about a whole year of information that has to be consolidated into financial statements, but we want to do that within a couple months. Well, what's useful of that information if we don't give it to our shareholders until December of the following year? So 12 whole months have gone by before we're able to give that information to shareholders. It's not timely. It doesn't mean that the information is useless, but it's not useful, right? 12 months out. That's kind of like, you're sitting in a chair probably right now watching this video. Hopefully, maybe you're standing on a bus watching this as you're going down the freeway, or maybe you're watching this while you're driving. You shouldn't be watching this while you're driving. But anyways, maybe you're sitting down and I told you that if you look under your seat right now, you'd find an envelope, and in the envelope, there would be $100. And so you check that and you're like, well, there's no envelope. But what I failed to tell you is that I put that envelope there 5 months ago. Well, 5 months ago to today, that's a long time. Something could have happened to it. It could have been stolen. You could have lost it. Maybe your roommate took it, whatever. That's not timely. That information, I should have told you that a few hours or even a day after I put that money underneath your chair, right? So that information is not timely, therefore it's not as useful as if I told you on the day that I put an envelope underneath your chair. So that's what timeliness does for us. The second one is that it's verifiable. And what do we mean by verifiable? Is that you as an accountant who puts together the financial statements, we should be able to have another accountant come in, sit down at your desk and redo everything and come up with substantially the same amount, same numbers as you did. So it is verifiable because someone can actually reproduce those numbers and get pretty darn close. Now, there's a reason why I'm not saying exact. Accounting is all about judgment. And so you might not see this initially here in this course, but towards the later of this course, and if you go into intermediate and advanced, you're going to find out that a lot of accounting sometimes takes professional judgment. And that professional judgment at the end of the day is what makes the difference between financial statements maybe being a little bit higher or a little bit lower or right in the middle. And so when two people are doing it, they may get just a little bit of a different number because maybe they just used a little bit of a different technique to get to that number, but they're not going to be totally off. So although we would love an accountant to reproduce it perfectly, they might not exactly be at the same number as someone else. So substantially the same would be what we would expect that other accountant who comes in to redo your work to get to, okay? Now, that doesn't mean that they can't be an exact. So if they do it and they get exactly what you did, and that's fine. That is exactly verifiable, but sometimes we have that margin of error, and that is okay in accounting. Not okay for assignments, let's say, but okay for accounting here when we talk about real world accounting and using that information to prepare financial statements. The next thing that we can use, the next thing that will help improve the usefulness of a financial statement is comparability. Can we compare it? And what do we mean by compare it? Can we compare it from this year to last year to the year before? So we're using the same principles and the same rules. So the way that we calculate X number, we're calculating it the same way a year later so that we're able to compare those numbers with last year's numbers with the year before numbers. And so it should be comparable. That also means that two like companies should also be comparable as well. So for instance, maybe we can't compare Ford and Honda, but maybe we can compare Ford and Chevy, right? We can take both of their financial statements, both are based in the US. Financial statements are both in US GAAP. We can compare them and kind of see the difference between both of them, even though one might be slightly bigger than the other. Okay, so comparability. And lastly, understandable. So at the middle of this course, or actually maybe now, I'm probably confusing you with these terms that we talk about in accounting. And you might be going, well, what is an asset? What is a liability again? Well, at the end of the day, we want financial statements to be understandable to the user. So we want to make them as easy for that user to understand. So what GAAP does is it tells us kind of what rules we need to follow when we report things. And we're not going to report on very complex things, although they may be important. We might find another way, but we're going to do it. We're going to prepare the financial statements in a way that someone with a basic business knowledge is able to understand the financial statement, and there are no real technical things in that financial statement that they just don't understand. That doesn't mean we won't cover that in the financial statement. That just means that we're going to have to find another way to report it or to show it so that it makes sense to that average business person. So these are 4 things that will help with the usefulness in enhancing a financial statement or the information that we're providing to external users. So these are some of the guiding rules of accounting. I can tell you that there's so much more that we're going to cover, but that's kind of it for the basics here. And again, the intro here section is all about giving you kind of a thin layer of a foundation of understanding how accounting works. And these are the rules that we follow, one being US GAAP, another being IFRS. And the whole purpose is to make sure that they're relevant and they're useful to the decision maker. So I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it is Patrick. Don't forget to press the like button and share this video with someone who could get a lot of use from watching this lesson, like maybe a classmate or maybe a friend or maybe just a parent, just because you wanted to share this video because you're very excited about what you saw. Share it with someone. And if you want to help us grow and help us make sure that we put the very best in accounting topics out on YouTube, make sure you press the subscribe button and turn on that notification bell. That way you're alerted every time we post videos to this channel. Now, I do this with every one of my classes at the end of class. What did you learn from this lesson? Put that in the comment section below and I'll respond to you on what you got out of this video. So hope you enjoyed this video and we will see you in the next lesson.